Welcome to the deep dive. Our goal is always to cut through the noise, take all that complex info you've gathered, and we'll make it immediately useful. Today, we are really digging into real estate investing, specifically those two big engines that drive pretty much all returns: cash flow and appreciation. If you're an investor or maybe thinking about becoming one, these terms, they're basically the foundation, right, for every decision you'll make. But, and this is key from our sources today, they're not really equal. We're going to unpack exactly how each one contributes to, financial freedom. And maybe more importantly, why one of them is often the sort of silent exponential force behind building true generational wealth. Okay, let's get into it.
Yeah, it's definitely more than just definitions. It's really about strategy. A lot of new investors, they chase that immediate cash flow, feels tangible, right? Money in the bank each month. But they often miss the strategic power that appreciation holds over the long term. They serve different purposes, really. Cash flow helps with immediate needs, stability, appreciate. That's all about multiplying your capital over, say, decades.
Okay, so let's nail down the definitions first, because the details matter, especially when we're talking metrics. When we say cash flow, we mean the actual money left in your pocket after everything's paid, right? Mortgage, taxes, insurance, repairs, management fees, all of it. It's the net profit, pure and simple.
Exactly. And, while the raw dollar amount is nice, experienced investors look deeper. They talk efficiency. They use the cash-on-cash return metric. That's your annual pre-tax cash flow divided by the actual cash you put into the deal initially. Your down payment, essentially. That percentage return on your actual invested cash, that's way more useful than just knowing, say, you made $500 this month.
Right, that's the stability measure. Now let's switch gears to appreciation. Appreciation is, well, simpler on the surface. It's just the increase in the property's market value over time. Bought for 300Ks, now it's worth 500K. That $200,000 difference, that's your appreciation.
And here's really the core insight that the data keeps pointing to. Appreciation tends to drive the majority of long-term gains. And a big reason for that is leverage.
Okay, explain that connection, because that idea of appreciation being the true wealth builder, that really hinges on understanding leverage, doesn't it?
Absolutely. Think about it like this. You buy a, say, $500,000 property, but you only put down 20%, right? So that's $100,000 of your own money. You're leveraging the bank's money for the other $400,000. Now, if that property appreciates by just 5% in 1 year,
Which is $25,000.
exactly, $25,000. But here's the kicker. That $25,000 gain is on the entire $500,000 asset value, not just your $100,000 investment. So you just made a 25% return on your actual cash invested, 25K gain, $100 cash, purely through appreciation, just because you borrowed the rest. That compounding effect, using leverage on the asset's value, that's the real engine room for accelerating wealth over the long term.
Wow, yeah. That really puts it in perspective, using debt to multiply your equity gains.
Okay.
But let's not completely write off cash flow. It has its place, right?
Yep.
Let's talk about its role, specifically for stability and resilience. What are those immediate, tangible plus sides of having positive cash flow?
Well, its main benefit is really risk mitigation. Cash flow makes the asset self-sustaining. If your property brings in enough each month to cover the mortgage, all the expenses, plus setting aside something for maintenance, then you don't have to panic if you, say, lose your job for a bit or if the HVC suddenly dies. It gives you breathing room, financial stress relief. And that relief has huge, non-monetary value. Peace of mind is worth a lot. But there's a nuance here that sometimes trips up newer investors. Every month when you make that mortgage payment, part of it reduces the principal loan balance, that principal pay down. That is building equity. It's a form of wealth creation, absolutely. But it's not cash flow profit. Cash flow is the money that actually hits your bank account. Principal reduction is just the slow, steady increase in your net worth that happens behind the scenes.
Okay, so cash flow is about managing risk, providing income day to day. Appreciation is more about maximizing the upside, multiplying wealth over the long haul. And this is where it gets really interesting, because the sources we looked at point out appreciation doesn't just happen randomly. There are key mechanisms. We talked about leverage, but there's also the tax side of things, right?
Well, absolutely. Leverage is one huge mechanism. The tax code is definitely the second. So while appreciation is the market value going up, the government actually lets you use something called depreciation. It's a non-cash expense. And you can use that depreciation to offset the rental income you receive. Think about that for a second. You're building equity through appreciation, and your tenant is paying down your loan principal. And you might be getting monthly cash flow on top of that. But because of depreciation on paper, your actual taxable income from that property could be zero, or even negative for years sometimes. This tax advantage, tied specifically to owning an appreciating asset like real estate, makes the long-term play incredibly advantageous.
So it's that double whammy leverage, multiplying gains and tax shields protecting income that explains why, over 10 or 20 years, the total gains from appreciation can just dwarf the accumulated cash flow profit. The scale of growth is just fundamentally different. But the documents also highlighted a really crucial distinction here. Appreciation isn't all the same. There are like two distinct types, and your control over them differs.
That's exactly right. First, you've got what we call natural appreciation. This is passive. You basically buy and hold, and the market does the heavy lifting. Natural appreciation usually follows two main things: strong job growth in the region, especially high-paying jobs like tech or specialized manufacturing, and critically, regulatory stuff that makes it hard to build new houses, things that limit supply when demand is high. That creates a structural shortage.
Okay, so that's the market lifting all boats, sort of. What's the other type?
The second type is forced appreciation. Now, this is active. This is where you, the investor, actively force the value up faster than the general market. You do this by adding value, renovating an old kitchen or bathroom, maybe converting an unused space into another bedroom, adding laundry facilities. These are capital improvements that ideally return much more in increased property value and, importantly, higher potential rents than what they cost you.
Wait a minute, though. What if I spend, say, $50,000 renovating a kitchen, but properties in that specific neighborhood just won't sell for more than $20,000 higher, regardless of the kitchen? Haven't I just forced appreciation on myself? How do you avoid overimproving?
That is the critical risk with forced appreciation. You absolutely have to understand the local market ceiling. What are comparable, updated homes actually selling for in that immediate area? If you spend way too much, you've just sunk capital. You'll never get back when you sell or refinance. So the smart investor focuses on improvements that either significantly boost the rent potential or appeal to the broadest group of buyers, making sure that cost to value ratio works out. If the upgrade doesn't lead to higher rents or make the property sell faster or for more, it's probably wasted money and effort.
Okay. That distinction leads us straight into geography, doesn't it? Because the type of market you invest in heavily influences whether you're playing the cash flow game or the appreciation game. You can't really expect, like, California-level appreciation in a town with a flat economy, even if the cash flow numbers look amazing on paper. Our sources break down markets into basically three types. Let's start with cash flow markets. These are often in lower cost areas, maybe parts of the Midwest. What defines places like Ohio, Indiana, Kansas as cash flow spots?
Yeah, the main thing there is usually a combination of low property prices, low land value, really in relatively high rent-to-price ratios. You can buy the actual building pretty cheaply, maybe because the housing stock is older or population growth isn't booming, but there's still consistent demand for rentals, perhaps from stable, lower-wage jobs, or maybe a local college. So the rent you collect, compared to your purchase price, gives you a really strong cash-on-cash return. You might see 10, 12%, sometimes even more. The trade-off, though, is that long-term appreciation might just barely keep up with inflation. So your big equity pop at the end isn't likely. You sleep well at night because the bills are paid, but it's not usually a get-rich-quick strategy.
Right. Stable, but maybe slower growth. Contrast that with the second type, appreciation markets. These are your high-demand coastal cities, major tech hubs. California, Washington, Massachusetts come to mind. Here, investors often accept minimal or sometimes even negative cash flow at the start. Why would they do that?
Because it's the complete opposite dynamic, essentially. Land value is incredibly high, often astronomical. And things like strict zoning laws or just the sheer cost of construction mean new housing supply can't possibly keep up with the demand fueled by high-wage job growth, like in tech or finance. So you might put down, say, $200,000 on a property just to break even each month, or maybe even lose $100. Your cash-on-cash return looks terrible, maybe zero or negative, but you're not buying it for the monthly check. You're betting on that powerful natural appreciation driven by those economic factors. Over 10 years, that same property might double in value. If that happens, the small cash flow loss you endured along the way becomes pretty much irrelevant in the grand scheme of things.
Okay, so you have the steady income markets and the high growth, maybe higher risk markets. But then there's this third category, kind of the holy grail for some investors, the balanced market. These are places that supposedly offer a mix, right? Decent cash flow and strong appreciation potential.
Exactly. And these markets are really interesting because they often represent a specific point in a region's economic growth cycle. They typically have strong, positive net migration, more people moving in than out, and solid job creation, similar to the appreciation markets. But crucially, Their housing prices haven't yet reached the stratosphere. They're still relatively affordable compared to, say, the Bay Area or Boston. And maybe there's less red tape holding back construction. The data we looked at often points to places like Utah, Colorado, and certain parts of Texas as showing these balanced characteristics.
Utah comes up a lot as a prime example of this blend. What is it about the fundamentals there, or in similar places, that allows for both decent cash flow and strong growth?
Well, it often boils down to that growth momentum meeting current affordability. Utah, for instance, has seen huge population increases driven by tech moving in, lifestyle appeal, etc. That creates the upward pressure on prices, the appreciation. But at least historically, the cost to actually buy property there was low enough that investors could still find deals that generated positive cash flow right from the start or close to it. That combination is pretty rare. Strong economic tailwinds suggesting future equity growth, while today's prices still allow for a respectable cash-on-cash return. It's potentially the best of both worlds, assuming you got in at the right time, of course.
This whole breakdown really clarifies the strategic choices, doesn't it? So if you're listening and thinking about your own situation, your own portfolio, how do you actually decide which type of market to target?
It really has to come back to your specific investment goals and, frankly, where you are in life. If you need extra income right now, maybe to supplement retirement, maybe pay for college, you pretty much have to prioritize cash flow. You'd be looking at those cash flow markets. But if you're, say, 30 years old, you have a good, stable job, and your main goal is building maximum wealth for retirement decades down the line, then you should probably be willing to accept lower or even negative initial cash flow to get into those high-growth appreciation markets. You're playing the long game, leveraging time, appreciation, and those tax benefits. Which brings up an important point. Does it have to be only one or the other? Smart portfolio building often involves diversification. You could potentially balance your needs by investing across different market types. Maybe use some Midwest cash flow properties to provide that income safety net, that liquidity, while your properties in faster growing areas act as your primary long-term wealth accelerators. It hedges your bets in a way.
So, wrapping this all up, what's the big takeaway here? It seems like cash flow and appreciation are just fundamentally different tools in the toolbox. Cash flow gives you that essential stability, the resilience, the day-to-day income. But appreciation, especially when amped up by leverage, helped by taxes, and compounded over time, that seems to be the real engine for building massive wealth. So before you jump in and invest, you really need to sit down and analyze your own financial picture, right? Your goals, your income needs right now, and maybe most importantly, how much risk you're comfortable taking. Don't chase that flashy 12% cash on cash return in a flat market if what you truly want is multi-million dollar equity growth over the next 30 years.
Exactly. And maybe here's a final thought for you to consider. Given that appreciation generally drives the lion's share of wealth creation in real estate, and considering how important those factors like leverage and tax advantages are, how truly rare and valuable is a market that genuinely offers both, a place like, as the sources suggested, Utah, that might give you not just that aggressive long-term growth potential, but also the immediate comfort of cash flow covering expenses from day one. For an investor who wants both security and maximum growth, finding that perfect blend, that truly balanced market, well, that might just be the most optimal and perhaps the most elusive strategy out there today.